All right, why don't we get started? So thank you guys for joining. My name is Mark LaMonica. I am going to spend the next hour or so talking about bonds. So we'll learn all about bonds today, which hopefully will be somewhat interesting. But before we get started, anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. If you would like personal advice, you should reach out to a financial advisor. If you're over in New Zealand, you can get a copy of our FAP off of our website, morningstar.com.au. So, as I said, we're going to talk about fixed interest today and the world of bonds. So, if you have any questions, send them through. I will say also that we're a little bit behind, once again, with getting up the previous sessions onto YouTube. We will do that. But yes, we are a little bit behind. So sorry about that delay. All right. So let's get into this. So you of course can listen to our podcast, follow us on Instagram, not our fake account. There's now a fake account. I don't know if that's I don't know what that is. Maybe that means that we actually are successful with this thing. But anyway, don't follow our fake account, Morningstar Investor AU. Our conference is coming up. You can still join the wait list Thursday, 13th of October. We will release the agenda soon. It is a strong agenda, so hope to see you guys there. You can meet in person. All right, fixing income investing. So we're going to start very, very basic. And then hopefully we'll build up a little bit with what we're talking about. So a bond, what is a bond? A bond is a loan. So companies can go out there and they can access capital in a couple different ways. Of course, they can generate it themselves. That is just through cash flow from going out and selling goods and services, paying all your expenses and keeping it. But also, you can issue shares, which of course we talk about a lot. That is selling an ownership stake in the company. But another way, of course, to access capital is by issuing bonds. So not only do companies do this, but of course, governments and various government entities do this as well. So very simply, this is a loan. Just like going to the bank and getting a loan, a bond is just a different way of doing that. So got a little diagram of what bonds are. So Will is going to weirdly film something else during this. It's all very confusing. Hopefully, mostly we'll be filming Emily, who's sitting in the room. But anyway, let's talk about what a bond is. So when you purchase a bond, if you are buying a $100 bond, you are, of course, loaning $100. So that money will go to the bond issuer. So as I said, a government or a company. That loan, of course, will have terms. Those are the terms around the bond. So in this case, you're purchasing a bond, $100 bond. So that's the face value, matures in 5 years. So when you get your money back, and you get a 5% interest rate per year. So that money goes to a bond issuer. And then every year they will pay you that interest, in this case, 5% interest. And then they will repay you the principal of $100 at the end of the term of the bond. Of course, as long as they can pay that back. So that's our very basic framework. And we will go from there. Okay, a couple of things. As an investor, we're talking about what roles that bonds play in a portfolio. So bonds are typically used to lower the volatility in a portfolio. So what does that mean? It means that as investors, when we talk about risk, and there's some other risks, but primarily when the investment industry talks about risk, they're talking about volatility. They're talking about how much an investment will bounce around in value. So when you are an investor in anything, when you are an investor, what you are doing is you are exchanging risk for return. So that is kind of the deal you have there. So the more risk you take on, the more volatility, the more an asset price will bounce around, the higher the future expected return should be. So growth assets, when we talk about growth assets, we mean things like shares, listed infrastructure, listed real estate. Those are growth assets. You get higher amounts of volatility, and you should get longer returns over the long term. Bonds have lower volatility and therefore lower expected returns over the long term. So the more bonds you put in your portfolio as an investor, the lower the volatility of that portfolio will be. At the same time, the lower the expected returns of that portfolio will be. So let's put this in sort of Morningstar goals-based investing speak. When we are trying to build a portfolio, we want to focus on our risk capacity. That means how much risk do we have to take on? How much volatility do we have to take on in order to achieve our goal? And when we think about goals and we think about defining those goals and defining the way that you're going to achieve them, we think about, okay, how much return do I need? How much can I save? How much, of course, do I need for that goal? And when do I want to accomplish that goal? And we do that. We calculate the amount of return we need because then we know our risk capacity. We know that we have to take on a certain level of risk to be able to get a level of returns to actually achieve that goal. And that's why we invest in the first place. So if you have lower expected returns or lower required returns over the long term, you could have more bonds or something like cash in your portfolio. If you need higher expected returns or higher required returns, then you need assets that have higher expected returns. So that's why you need to take on more risk with more growth assets. All right, so investors do lower the volatility of their portfolio with bonds. And there are times in your investing life when that's really important. So that could be number one, as you're approaching a goal and you're worried about your account bouncing around in value because you need that money to pay for something. So an example of that could be if you're trying to buy a house, for instance, the last thing you want to do is have the market fall right before you buy a house. So that's when you'd want to lower volatility. You might want to do it as you approach retirement because of sequencing risk. So the risk that the order of the returns that you receive are going to impact how long your portfolio can last, right? You don't want low returns right as you go into retirement because that'll make your money run out faster. Those are instances where you may want to tilt your portfolio towards bonds. We'll talk about some of the downfalls of that in a second. All right, bonds are not the only thing that you can do to lower the volatility of your portfolio. So while bonds have less volatility than shares, they have more volatility than cash. So of course, cash, you keep cash in a bank account, you keep cash in a term deposit, there is no volatility, right? It's government guaranteed. You know that if you put $100 in there, it's not going to change in price. You'll get a little bit of interest. So you have really low expected returns, but zero volatility. Bonds are still volatile, and we'll talk about that in a second. There are other ways to lower the volatility of your portfolio. So you can use cash, or you can look at less volatile growth assets. So we talked about that a lot on here. Dividend paying shares, larger companies. There's lots of different things you can do from a portfolio perspective, even within growth assets, within that chunk, to lower volatility. All right. Bond prices, and this is pretty important. So while bonds have lower volatility, they bounce around in price less than a growth asset, they still move, and sometimes significantly. So it's really important to remember. We'll spend some time. But there are really three things that impact the price of bonds. So we'll go through each one of these. Now, if we get very technical, maybe there's a couple other things, but these are the three main things that change bond prices. So changes in interest rate levels. So bond prices move inversely to interest rates. So that means that if interest rates are going down, bond prices go up. And we'll explain why in a second. But just remember that principle. If interest rates are going up, bond prices go down. So that's important. We're going to talk a little bit about the yield curve. So I'll save it for when we have a chart because it's actually easier to explain then. But changes in relative levels of interest rates across maturities. So how long a bond has until it matures, which is the yield curve, those changes can also impact bond prices depending upon where you are on that yield curve. And then changes in credit spreads will impact bond prices. So once again, we'll explain that one again, but very simply, what it means is that as an investor in a bond, you're of course worried about the interest rate and different terms in the bond, but you're also really worried that they pay you back, right? Like any sort of loan, you need the person you're lending money to pay you back. So matters, of course, if they default, but it also matters what the market thinks about the likelihood of somebody paying you back. So if the bond market collectively, if investors collectively think there's more of a risk that a certain entity, a certain type of bond perhaps, is more at risk of not paying you back, then of course they'll demand a higher interest rate because that's how they're getting compensated for that, for the increased risk that they're taking on. If you hold that bond and the market decides they want a higher interest rate, your bond price will go down. Conversely, people could collectively decide that a certain issuer or group of bonds is safer. And of course, that credit spread will narrow, which is a good thing for you if you hold those bonds because they'll go up in price because that interest rate will go down because the market deems them safer. So we'll spend a little bit of time talking about credit spreads in a second. All right, let's start with changes in interest rates. So as I said, this is just some chart saying exactly what I said, but some people are visual learners, right? So prices fall, yields rise, interest rates go up. Of course, investors are going to get more for newly issued bonds, but the prices of existing bonds will come down. Same thing if interest rates fall. So if we look at the environment we've been in, and we go back to the early 80s when inflation was very, very high and central banks rose interest rates significantly to battle that inflation. Since that time, interest rates have just come down. Obviously, it's not been in a straight line, but the trend has been down. So bonds have done very, very well. So we'll show in a second, in the last year, bonds have done very, very poorly as interest rates have gone up. So that's what we need to worry about as bond investors. And we'll talk about why. All right, so we'll walk through this example. First, I think we might have a question. Yes, so David has a very good question about investing in direct bonds versus bond ETFs, which I'll get to because there's a lot of confusion around that. All right, so John says, will interest rates in banks be going up? All right, a little bit of a separate topic, but very quickly, will they be going up? Yeah, eventually they'll be going up as long as interest rates go up. Listen, banks obviously immediately like to pass on higher interest rates to, of course, people they're lending money to. So very quickly, they like to jack up the interest rates that they would charge on a mortgage, for example, and they're a little slower pushing them back up for a term deposit or for just a savings account that you have. And one of the reasons for this is obviously this allows them to make more money, all right? They source funds from somebody, much like a company that issues bonds. You go out there, you source funds, and your cost of capital is whatever interest rate you pay, and then you do something with that money. In the bank's case, you lend it out to people. So if the bank can increase those interest rates that they charge customers on mortgages and not increase the interest rates that they're paying people, that's a very good thing for the bank, not for you, on either side of it. So other thing to consider about banks is one of Morningstar's moat sources is something called switching cost. And switching cost basically refers to if something's at a pain to go out and change, people don't do it, right? It's kind of the laziness moat factor. So banks have switching costs. And basically what that is they know that you're not going to go out there and change your banks unless you absolutely have to. Because at the end of the day, you've got all these different things set up in your account. You've got all of your friends' bank account information. You can pay them. You've got your direct deposit from your paycheck going in there. You've got bill pay. You've got your credit cards connected to it, so you usually pay. People do not want to switch their bank accounts, and the banks know this, of course. So they know that if somebody else raises interest rates a little bit, you're probably not going to switch unless that gap becomes significant. So anyway, slightly off topic, but yeah, that's the issue. So eventually those interest rates will go back up. The other thing to remember is that Australian banks get a lot more of their funding from customer deposits than a lot of international banks. So, an extra incentive for them not to raise those rates. All right, so let's walk through this example of how changes in interest rates impact bond prices. All right, so we've got two scenarios here. We have a newly issued bond, $100 face value. So that face value is what the bond's issued at. It's what you will get back at the end of the term. Coupon payment, $3. So they'll pay you $3 a year. The yield in this case is 3% because interest rates are at 3%. All right, so $100, 3%. They're issuing this at face value. Means your coupon payment's $3. Maturity 5 years, so they'll pay you back in 5 years. And the price is $100. So of course the price is $100 because the face value and the coupon payment equal a 3% yield. We have 3% interest rates. That makes the price $100. Now, people can issue newly issued bonds at all sorts of different prices. And as you'll see, what they're doing is they are creating equilibrium with that interest rate of what's in the market and what they're actually paying. All right, so you've got this newly issued bond. It is a year from now. Now your bond is trading on the secondary market. So basically, just like shares, bonds are issued, but then you can buy and sell bonds. And the bond market actually is significantly larger than the equity market. So just something to remember. A lot of people go out there and buy and sell bonds, even if you are not one of them. All right, so it's a year later. Interest rates have gone down. So they've gone down to 2%. So I still own this bond. I bought it a year ago. So now face value is still $100. They'll still give me back $100 at maturity. I'm still getting $3 a year in interest, right? Because that was the original agreement. Now, all of a sudden, we have a change in interest rates. So why would anybody go out there and buy my bond for $100? Well, they would do that because it'd be a great deal, right? If I could go out there and buy this bond for $100, all of a sudden I'm getting 3%. I'm getting this $3 coupon payment, right? So it's a really good deal for me. So this bond's more attractive than a newly issued bond, right? A newly issued bond at 2%, I'd only be getting $2 for my coupon payment. So I'd want to go out there and buy that bond for $100. But of course, the seller knows this. So the seller is not going to charge you that. What they're going to do is they're going to recalculate something called the yield to maturity. So the yield to maturity is looking at, and don't worry about sort of all the sort of more complex terms. Think about just what's actually happening here. They're going to equalize that interest rate so that it equals newly issued bonds with the same maturity. And they're going to do that to get that yield lower. They're going to raise the price so that these two bonds essentially become equivalent. And so you have to trust me with the math on this thing, that if I go out there and buy this bond for $103.81, it is equivalent to me buying a newly issued bond at 2% at lower interest rates. So this is why when interest rates go down, the price of bonds go up. Conversely, if the opposite thing happened, if interest rates went up to 4%, who is going to want to buy my 3% bond at $100? They're not. So what's going to happen? That price is going to go down once again to equalize those interest rates. So it's again yielding 4%, even with this $3 coupon. All right, so hopefully people got that. I know it takes a little bit of thinking, but that's basically what happens with bond prices, because bonds are continually issued. So even large governments are continually doing weekly auctions of bonds. So there are a lot of bonds out there. Companies are continually issuing them, retiring them if it's a good idea, because they're trying to source funding to run their business. So there we go. All right. Okay. Let's talk about the other thing that happens, changes in the shape of the yield curve. All right, so the yield curve, and we've been hearing a lot about the yield curve recently, or at least some people have. Let's talk about the yield curve. So all the yield curve does is it looks at yield. So how much interest are you getting? What's the percent interest you're getting on the bond you have. So we've got yield on this axis, and then we've got maturity. A normal yield curve, which is this one right here, a normal yield curve, you get paid higher levels of interest rates for the further that bond is from maturity. And this makes sense, right? If I'm going out there and lending my money to someone, first off, just from a credit perspective, if I'm lending out to a company and I'm choosing between 30 years, I'll lend it to them for 30 years, or I'm lending it to 1 year, what's safer? Well, 1 year is a lot safer, right? The fortunes of that company have a much larger chance of changing significantly over 30 years than they do over 1 year. Also, there's simply the time value of money, right? That $1 today is worth more than $1 in the future. Conversely, $1 a year from now is worth more than $1 30 years from now. So very simply, in a normal yield curve, you get more interest if you go out longer on maturity. But the shape of that yield curve can change. It's not set. There's no rule out there saying, for, I'm making up these numbers, for a 1-year maturity bond, you get 2%. For a 30-year maturity bond, you get 5%. So all sorts of things can influence that yield curve. So a yield curve can flatten. So if a yield curve flattens, that means the relative difference between short maturity bonds and long maturity bonds, they're starting to change. It can get completely flat, where you're getting the same thing, right? That you will lend money to somebody for 1 year and you'll lend money to them for 30 years, and you're going to get the exact same interest rate. Or they can invert, which always makes me think of Top Gun, where he's talking about being inverted. Emily only saw the new one, so she still does not get that reference, but you should go watch the old one. An inverted yield curve is when you are actually getting higher levels of interest for a short-term bond than a long-term bond. Now, you're probably thinking, why on earth would anyone do that? Well, a lot of this, of course, is supply and demand and where people are buying along those yield curves, right? The more people that are buying in a certain area will, of course, change the prices of those bonds, right? It will push those prices up, which, of course, will lower that yield. So an inverted yield curve is a classic sign that we are going into a recession. Now, we've been in an inverted yield curve this year, so sort of take that as you may. But what this matters for as an investor is it means the choices that you make of what kind of bond, where you buy along that spectrum, are going to matter, because as the shape of that yield curve changes, even without overall interest rates changing, or even if rising or lowering interest rates affect one part of the yield curve more than the other, that's going to affect the price of your bonds. That's going to impact your return. So you'll hear these terms: inverted yield curve, a flattening or flat yield curve, or a steepening yield curve, where it's getting more normal, where these long dated bonds are actually going up in price. All right. So the third example that we're going to talk about, or the third thing we're going to talk about, the change in price, and we don't have a nice fancy chart, so unfortunately you have to look at me for a second. A third example that we're talking about is we're going to talk about changes in levels of interest rates. So what you'll hear a lot related to bonds is you'll hear about the risk-free rate. So the risk-free rate refers to what is the level of interest rates that I can lend somebody money at and guarantee I get it back. So, right, it means there's no credit risk. There's no chance that this entity will not pay me back. Now, you're probably thinking, how can anybody guarantee that? Well, basically what that means is you are borrowing from a AAA rated, so there's credit ratings on different bonds. You're borrowing from a AAA rated government that is issuing bonds in their own currency. So typically what they refer to then is US Treasuries in this. And you're probably sitting there thinking, well, okay, how is that possible? You know, the US government and a lot of governments around the world have a ton of debt. How is that actually risk-free? Well, it's risk-free because if you are a government who controls currency, who is issuing currency in your own issuing bonds in your own currency, then you can definitely pay anyone back because you can just print more money, right? So the concept's pretty simple, right? If the US government needs to pay you back on your bonds, they could just print more money because they create US dollars and they can pay you back. Now, obviously, they don't want to get in a situation, no government wants to get in a situation where people don't trust you anymore, because then the interest rates will go up a ton on all of the newly issued bonds, but they can technically pay you back. And so when we go and we look at countries that have defaulted, they're generally defaulting because people don't trust their government and they refuse to lend them money in their own currency. So you start seeing countries like Argentina issuing bonds in US dollars. The Argentinian government cannot print US dollars. They can go out and get them in other ways, not if their currency collapses and not if people are just not lending them money or trading with them. So that's generally where countries get in trouble, and they are way down beyond this realm where somebody would pay them back once they get there. So anyway, that's the risk-free rate. So the risk-free rate matters because that is, when we think about credit risk, that is going to sit right at the bottom. And then as you get riskier and riskier countries or companies, you start to build in a credit spread. So the credit spread may be between a AAA rated, which is the highest rated bond, and a BBB rated bond, right? And so the market, based on how nervous they are about other people paying back, will adjust those credit spreads, right? So typically what happens is if you go into a recession, they start to worry about companies being able to pay back. So what happens then? Then those credit spreads may widen, and they keep going up all the way till you get to high yield bonds. And high yield bonds are just a fancy word for junk bonds. So those are very, very high yielding. High yield is like the, nice little moniker they put around them during that whole leverage buyout thing in the 80s. But they used to be referred to as junk bonds, and still are in some areas. And those are people that have very, very high credit risk, where you could be buying these things on 50 cents on the dollar because nobody thinks that company is going to pay you back. And if they do, you make a lot of money. If they default, you lose all your money. So yeah, something to think about. So those credit spreads, the changes in those credit spreads are going to impact, they're going to impact the return that you get on bonds. So if riskier bonds, if the market deems them safer, the price will go up, and that will be good for you. So anyway, just the last thing that you can think about. Let's see. All right, I'll try to figure out how to get back into this. So we're going to go through a couple bond myths, and then I will get to some questions and we'll look at a couple examples. So bond myths. Okay, so myth one, and this is where we'll talk about the difference between ETFs and buying a real bond. So myth one, as long as a bond doesn't default, I won't face a capital loss on that bond. All right, that is not true. So what I've done is I've taken an ETF, IAF, which is an Aussie Composite Bond Index, and I just simply looked at how this thing performed this year. I don't know. All right, as you can see, the thing's down close to 16%. So, and it's rallied lately. This is a perfect example of the fact that you can lose money, and you can lose a significant amount of money investing in bonds. And of course, what has happened this year? Well, what's happened is the market expectations for future interest rates and the increases in interest rates that central banks will have to go through has increased significantly, right? And so, of course, that is going to bring bond prices down. So you can face a capital loss, and a permanent capital loss, on bonds if you invest in them in ETFs and the interest rate changes. So let's explain that. Many people think about this when they're investing in a bond. They think about going out and buying an individual bond, and that's sort of the way that their mind works. And they sit there and they think, okay, so I've got a 5% interest rate. I think that's fair. I'm lending $100. So no matter what, as long as I'm lending to an entity, so let's say you bought an Aussie government bond and you thought, okay, they're definitely going to pay me back in 5 years. I think 5% interest rates is good. So I lend them the money. Who cares what happens with interest rates? Because no matter what, if this bond price goes up to $110 or it goes down to $90, none of it matters, because in 5 years, I will get my money back. So I will not face a capital loss. That is true if you buy an individual bond. That if you don't care about that volatility, how that bond price may bounce around, you're holding it till maturity, you'll get your money back as long as they don't default. The problem is that's not how an ETF works. The way an ETF works that is tracking a bond index is it will continually buy new bonds, bonds will mature. So that means the price, in theory, can keep going down and down and down and down for one of these bond ETFs. As long as interest rates keep going up, that ETF will keep going down because it has to continually invest in all these new bonds, because it's holding all these bonds that are sitting in this portfolio and they're not actually going to get to maturity. So ETFs can lose a significant amount of money. So just don't think of them as buying a pure bond. So it's just very different. So a couple myths that we've hopefully busted. You will face a capital loss if you invest in ETFs. That's number one. Number two, talked a lot about volatility at the beginning. So there's this myth that bonds diversify my portfolio because they always move in the opposite direction as shares. That is not true. That is not diversification, by the way, either. That's not why people diversify. Bonds will lower the volatility of your portfolio, but bonds and share prices can go down at the same time. And we know this because they did it this year. All right. This is down 15%. If I put VAS or some other ETF tracking the Aussie market, it would also be down this year. Right. And actually down less than this. So that is not true. Just remember, what you're getting is not something that might go up if shares go down. What you're getting is something that has lower volatility. So here's two different ETFs. So I looked at VAS, so Vanguard Australian Shares, and then this Aussie Composite Bond ETF. Went back 10 years, and I looked at the return per annum. So what they get, you can see a large difference, right, between shares and bonds, and that's what it should be, right? Not necessarily to this degree, but you should get more return over the long term by investing in shares because you're taking on more volatility. Then we have standard deviation. So standard deviation is a measurement of volatility. And what it's basically looking at there is it's looking at the percent chance, it's going back and looking at historic numbers and allowing you to sort of estimate the percent chance that you could experience a certain swing. So something with a standard deviation of 13.66, that means we're looking at the average return and the dispersion around that average return, meaning that it go down. So one standard deviation means about 66% of the time that return will be within one standard deviation of the average return, meaning 9.33 minus 13.66, 9.33 plus 13.66. So that's around 66% of the time. Around 95% of the time is within two standard deviations. So when we start talking about what are the tail risks in any market is outside of those two standard deviations, that last little 5%. You can see the bonds way more or way less volatile, right? The higher that standard deviation, the more that you've seen dispersion around that mean or average, the more volatile it is. In this case, very low volatility. So that is why you buy bonds. You don't buy bonds because they always move in the same direction as shares. So what we are seeing this year, those of you looking at this, what we are seeing with IAF, this ETF, that's down close to 16%, what we are seeing is a tail risk event. So something that is not supposed to happen. It's only supposed to happen in a very small percentage of the time. So when we look at 2 standard deviations, so what is that? That's a little over 7%, so 7.10%. Yet this thing has fallen close to 16%. This would be what we call sort of a tail risk, sort of a perfect scenario of something bad that happens. All right, so we're going to do one more thing, and then we can look at go through some of the questions. So there are some questions, so thank you for that. All right, so let's look at, hold on, sorry, I'm finding something. Where is this? All right, we're going to look at something called duration. So duration is a really important thing when you're trying to evaluate the interest rate risk that you have on a bond. So duration is a measurement of how much that bond bounces around in value based on changes in interest rates. Because depending upon the characteristics of that bond, you could have more interest rate risk or less interest rate risk. So for example, the longer the maturity is, the further away that bond is from maturity, the more it should bounce around in price when there are changes in interest rates. So it's something that investors look at a lot. So I found a screen that I will share with you that investors look at a lot when they're trying to measure interest rate risk. So remember, shorter maturity bonds are going to have lower durations, which mean less interest rate risk. All right, so I've gone to Vanguard and I got the fact sheet on the Vanguard Australian Fixed Interest Index ETF. VAF is the ticker symbol. And so if you can see on here, and I'll blow it up, there's this measure, effective duration. So this is an ETF that tracks a benchmark. So duration, just to really confuse people, duration is measured in years. So the effective duration of this ETF portfolio that, or this portfolio the ETF is tracking is 5.4 years. So what that means, what duration means, is that for every 1% change in interest rates, you would expect the opposite change in price, but of 5.4%. So it's a little confusing that they measure in years. So if interest rates go up 1%, you would expect the price of this portfolio of bonds, of this ETF, to go down 5.4%. So when you're going and you're comparing different bond ETFs, for example, and you're worried about interest rate risk, that's the figure you should go look at, this effective duration, which once again is confusingly measured in years. So yes, that's something you should look at. The other things, of course, we're looking at is, and these are all related. So looking at this portfolio, you can start looking, okay, what's the credit quality in this? All right, so AA plus, pretty good, right? And you'd also want to look at the same time, so what's the average maturity of these bonds? So relatively short in terms of maturity, 6.2 years. This is where we're all just looking at that portfolio. And we can see sort of the difference, that yield to maturity figure that I was talking about. So that is different from the coupon, right? Because yield to maturity gets impacted by interest rates changing. So that's what's showing us what we yield on that bond, which includes those coupon payments we get. And then, of course, that payment we get back at maturity for what we lent out. All right. We actually got some bond questions, which I think is good. Okay, so Daryl says, what is government quantitative easing and how does this affect the bond market? Okay, so what quantitative easing is let's talk about interest rates. So we all know that central banks control interest rates. So generally, well, not generally, the way that central banks control interest rates is they go and they look at very short-term overnight rates that they are lending to banks and the amount that they're lending to banks. So quantitative easing is banks going, or central banks going out there and buying government bonds to control different parts of the yield curve, right? So normally when we're talking about that overnight rate, those are very, very short-term rates. And so that's what central banks always used to use to control interest rates, until we got into the GFC, where this program of quantitative easing has happened. So what banks would do there is they would go out and buy government securities, right? So they'd go out and buy, the RBA would go out and buy loans, bonds that are issued by the Aussie government. And they go out there and buy them on the open market, and they would take them and they put them onto their balance sheet. So what they're doing by removing those bonds, right? What they're doing is they're lowering interest rates at different spots along that yield curve so they can keep all interest rates down. So that's what quantitative easing is. Now, when banks are unwinding these positions, you hear all this stuff talking about the Federal Reserve in the US. You'll hear about how their balance sheet is so big. Their balance sheet is so big because they bought all these government bonds. And what they're trying to do, well, what they're doing in one of two things. Either one, they're slowing the buying and sort of backing off that buying. So that's the first thing they're doing. They also are letting things mature, right, which reduces their balance sheet. And they could actually go out there and sell securities if they wanted, all right, which I think people would be very upset about. The market would be very upset about. So that's sort of quantitative easing, sort of the predicament that a lot of central banks find themselves in. Is they did this for years, and they did this during COVID as well. And like the Federal Reserve bought some strange stuff during COVID. So instead of just buying government securities and mortgage-backed securities, which is what they did during the GFC, during COVID, there was this huge fear that the slowdown in the economy would mean that all these companies would go out of business, right? Because like if their revenue stopped, they couldn't go out there and borrow money from the market or access funds in any other way. They just go out of business. And so a lot of central banks, including the US central bank, went out there and bought government security, or bought corporate securities, which is like a whole new thing. So the central banks have basically gone out there and bought all this stuff, and it's sitting on their balance sheet. So yeah, what they're trying to do is keep interest rates down. So what happened during COVID, there was this huge, we talked about credit spread. So everyone sat there and thought, okay, governments can pay us back, but companies aren't going to pay us back because the economy is going to shut down. So all of a sudden they shot up. That credit spread got a lot wider, meaning it made it more expensive for companies to borrow. So the government went out there, bought all, or Federal Reserve went out there, bought all these bonds to lower that credit spread, right? By stimulating demand for those bonds. So anyway, hopefully that helped answer your questions. Yeah, so Eric's saying, so what you want to do, Eric? So Eric's saying, although you don't want to do the detailed maths, can you explain conceptually why the 3% bond price doesn't rise to 104 as you get extra $1 a year of the remaining 4 years versus the 2% bond? Is that the dollar difference is impacted by the discount rate? What it's impacted by is also that you are now a year closer to maturity. So when we talk about yield to maturity, that goes into the calculation as well. So, I can't do the math in my head, but if you go look up on the internet, you can look up a yield to maturity calculator. And that's where I did that calculation, and basically go in there and look at those scenarios. What if interest rates are this versus how long you have to maturity, what those coupon payments are. And that's where you get it. So Frank says, regarding myth one, if you hold to maturity, then it will hold true and you won't make a capital loss, right? Yes, if you go out and buy an individual bond, right? Yeah, so Frank's saying that in the second question. Absolutely. So as long as there's not a credit event, as long as they do not default, you will not make a capital loss buying a bond as long as they pay you back, right, at the end. Doesn't matter what the price does in between. Now, remember, a concern of yours could be, well, you wouldn't make a capital loss. You could potentially come out way behind from an inflation perspective, right? Especially if it's a very long dated bond, that if you're not getting enough interest rates to make up, or high enough interest rate to make up for inflation, you could actually see the real amount of money, so the inflation adjusted money you have, drop. But no, you will not make an actual capital loss as long as they pay you back. So Joel's saying, are there better instruments than an ETF for bond exposure? Yeah, listen, let me talk a little bit about bonds. So one of the big problems with ETFs, I actually don't know if there's an active ETF tracking bonds, but fixed interest is a place where active management still does okay. So Morningstar has something called our Mind the Gap study that we publish every 6 months, where we go out and we look at actively managed funds and ETFs, and we compare them to the benchmark. And as I'm sure you guys have all read, maybe read, that in most cases, an active manager does not beat the benchmark. However, that isn't necessarily true in every single asset class. And one of the areas that active management tends to do better is fixed interest. And it tends to do better for a couple different reasons. So number one, just because there's a lot of things you can do as an active bond manager to differ your portfolio from the benchmark. So you could buy longer dated bonds, for example. So the benchmark, when we looked at that, Vanguard said the average maturity, forgetting the exact number, but 6.2 years. Well, I can go out there and buy 30-year bonds if I want. I can go out there and buy 1-year bonds. So you do have the ability, if you can forecast sort of interest rate changes. I'm not saying this is an easy thing to do. And you can forecast changes in the yield curve. If you can look at credit spreads, and there's a lot of stuff you can do as a bond manager that can differentiate you from the benchmark. And because there's so many different bonds out there, even going out there, the benchmark's not as representative of that overall population of bonds you can buy. So one thing you could potentially look for is look for active management. And I'm forgetting, of course, the name of the company, but there was a fund manager that has actually had a positive return this year, which is very difficult to do given what's happened with interest rates. So hopefully that answers your question, Joel. But yeah, there really aren't. There is no magic. There is certainly no magic way to go out there other than buying an individual bond where you cannot be exposed to capital losses. Yeah, so Frank's saying, are we better off buying bonds directly with durations that suit our personal goals so we can better control potential capital loss selling before maturity compared with bond ETFs? Yeah, I mean, I would say I'm not really supposed to be most of the time, yes. So, I think bonds allow you, in sort of this notion of duration matching that a lot of pension funds use, like bonds do allow you to go out there and look at liabilities that you may have and time bond purchases around that. So both time, look at, number one, the interest that you're getting in, and also looking at the maturity. All right. So and I'll throw out a scenario here, and it's not quite as good because we're in Australia, a lot of mortgages are floating rate. But yeah, in theory, if I'm on a 30-year fixed rate mortgage in the US, and I sit there and I say, okay, well, my mortgage rate is 3%. All of a sudden it's 10 years later and a 20-year treasury bond is selling for 5%. Even if I had the money to pay off my house, sit there and say, okay, well, hey, maybe not. I'll just go out there and buy a bond for that money. I know I'll get it back. I know I'll beat the interest rate. There could be situations like that. Obviously would not work with an ETF. So there are things that you can do depending upon your personal circumstances around individual bonds that you can't do with ETFs. And just because of that sort of capital loss component. Yeah, so David's saying, I guess buying and selling a bond ETF is easier than buying an actual bond. That is true. So Greg says, do you think that now might be a good time to buy into a bond fund? Well, listen, it's hard for me to answer this, but I'll say a couple things about the environment we're in. We still have, so my computer has run out of power. We still have, depending upon your view of what's going to happen, we potentially still have a longer runway of interest rates going up. And a lot of people are sitting out there, and sort of the market in general sitting out there and saying that central banks will probably have to cut next year because we could be in a big recession. Like maybe, but I think if you're going to sit there and buy bonds back in the early 80s, when you were getting 19% or whatever the crazy Fed funds rate was, that seems like a lot better environment for me over the long term to buy a bond, because the chances of interest rates going down from 19% or up from 19%, to me, it's a lot better that they're going down if I'm buying a longer term bond and I'm investing for the long term. Right now, interest rates are still low. So you've got a couple problems with interest rates being low. So number one, you are basically, well, you're not basically, if inflation isn't brought under control, you are definitely facing real losses right now. So you still have low interest rates. Yeah, maybe they can be cut more, but at the same time, what's the likely direction over the next 10 years? I don't know. In my mind, it's still up. So that's the thing that I'd be worried about. The other thing, of course, with low interest rates is you just don't get a lot of interest, right? So that's obviously a pretty big component of bonds. So we're sitting here, in my opinion, with kind of a rosy scenario that, you know, central banks will be able to, you know, even if they kind of throw the economy into recession, like they'll be able to get inflation under control and very quickly go back to cutting rates. I don't know. That seems like a very good scenario to me. So, you know, this stuff is like turning an aircraft carrier, right? It's very difficult to like have that level of precision with interest rates. So either chances are they will raise them too much and really throw the economy into the recession, or get spooked and stop raising interest rates and lower them too quickly, which means inflation will just take off. So that's basically what happened all throughout the 70s. These spikes, like inflation was very high, sort of from the 70s, mid 70s until like 82. Inflation was really high, but central banks kept backing off too early. And so what it took is Volcker, who was a Federal Reserve chair, like in the early 80s, threw the US economy into a really, really bad recession, because he basically said enough is enough, right? That like we've been doing this and living through this stagflation and like terrible economic environment because central bankers kept losing their nerve. And I'm just going to throw the economy into a huge recession to get inflation under control for good. And he basically did it, right? So inflation's been pretty low until recently, since kind of the early 80s. Interest rates have been going down, again, until kind of recently, although they haven't gone up that much since the 80s. So yeah, I don't know, Greg. I think there are certainly some concerns, but there are always concerns at any time you're going to invest. So it's, once again, very much about your goals. So Joel's saying, where do I find the comparison between ETFs and actively managed fixed interest on the website? Yeah, so what I would do is this. Oh, first I have to learn how to share my screen again. So sorry, I have a lot of tabs open, which I know many people think makes me some sort of psychopath. I don't really know where Emily falls in this. Shawnee definitely thinks I'm crazy. What do you think? You're very organized, so. Emily's still relatively new, so she's still kind of nice to me. All right, so what I would do is I go in collective investments, and then basically what you can do is just do the comparisons. So I would do actively managed. You look at ETFs, funds, or I don't think there are any ETFs, but, and go and look at global fixed interest. And so these would be our managers that we believe are going to outperform their index, so gold, silver, bronze, et cetera. So you can go in and look at some of these active managers. Then you can go in and look at some of the passive managers as well. So I would just use our research to compare some of those different ones. But yeah, you can toggle pretty quickly between that active and passive. So you can read what our analysts think about those different funds. Where am I? Now I'm very lost, which is shocking. Okay, let's see. So Anna's saying, if a bond matures and the issuer pays it out, are they not paying out at the higher 103? So you need to sell it before maturity. So I think that was probably a comment related to when we were going through. No, so they will always pay out. So basically the way that a bond works is generally, and there are obviously exceptions to this. So generally what they will do is that last payout will involve the principal that they owe you, so the $100 and the last coupon payment. Right, so the last payment. So yes, you would get $103 right at the end. But remember, those are made up of two different things. It's that annual coupon payment you're getting for every year when you hold the bond, and then that paying you back in principal. So yeah, just think of it like mentally, like you're kind of getting two payments just pushed together. Let's see, what else do we have here? No, it's just a bunch of messages from Emily mostly. That's nice, Emily. All right. Well, I think we might stop it there. But if you guys have any questions, since it's almost 2 o'clock, send me an email, mark.lamonica1@morningstar.com. And then I don't remember what we're talking about on Thursday. Do you remember, Emily? She has no idea. But if anyone's interested, you can come back on Thursday. Actually, I do. I have a list right here. I'm very organized, Emily. We're going to talk about investing in an inflationary environment, which should be pertinent. But anyway, thank you guys very much for joining. I appreciate it, and I'll be back on Thursday.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.